Okay, let's take a collective deep breath. In through the nose, hold it, and out.
Yeah, if you've opened your brokerage app in the last, 48 hours, you probably need that.
You might need a stiff drink, to be honest.
Or maybe just throw your phone into a lake.
Seriously. It is Saturday, February 7th, 2026, and if you've been doom scrolling through Reddit, I'm talking Earth stocks, value investing, places like that. The vibe is, well, it's manic.
Yeah.
It's a very, very weird weekend online.
Manic is putting it lightly. It's bipolar. You have half the people screaming that the sky is falling.
And the other half are yelling that this is the sale of the century.
Exactly. There's no middle ground.
That is the perfect way to describe it.
Yeah.
We're looking at a stack of sources today that paints this picture of a market that is simultaneously fine and absolutely on fire.
Right.
And our mission for this deep dive is to bridge that gap. We need to figure out why the headline numbers look so boring, but the comment section looks like a triage unit.
Yeah, we're going to unpack this three-way collision that's happening right now. You've got, one, the potential bursting of the AI bubble.
Okay.
Two, some very specific political anxieties about the new administration. And three, this breakdown in asset correlations that has people questioning, like, the basic laws of financial physics.
So let's start at the surface level, the everything is fine story.
Yeah.
Because if I just turn on the TV or look at a basic chart of the S&P 500, I'm seeing a weight.
A scratch. It's barely a flesh wound. The S&P 500 is down roughly 3% from its all-time highs.
3%.
Historically speaking, that is a bad Tuesday. It's noise. If you zoom out just 3 weeks, we're basically back where we started in mid-January.
One of the users in our source material actually pointed that out. They said, January 2026 was crazy up. This is just a rational pullback.
And mathematically, they are 100% right. If you look at the index as a whole, nothing catastrophic has happened.
Condon, it is a massive buck. You go into the individual portfolio discussions, and it is a bloodbath. We aren't seeing 3% drops. We're seeing people talking about being down 20, 30, even 40% in a single week. So what is going on? Why is there such a massive disconnect?
It's the concentration trap. The S&P 500 is market cap weighted.
Oh, meaning it's held up by the giants.
Exactly. But right now, there is a violent rotation happening just under the surface. The boring stuff, utilities, consumer staples, companies that sell toothpaste and electricity, they're holding the line. They're effectively masking the damage.
So the engine of the car looks fine, but the passengers in the back seat, the retail investors holding the high flyers, are just falling out the window.
That is a terrifying, but yeah, a very accurate analogy. The retail favorites, the high-growth tech, the crypto, all the speculative plays everyone piled into, they are getting slaughtered.
And the emotional toll in these threads is, it's really heavy. I was reading a post from a user, Unfair Explanation 53, and just listen to this trajectory. Last year, they were up 18%, $14,000 in gains.
Wow.
Felt like a genius.
Of course. The market has a way of making us all feel like geniuses in a bull run. It's that confirmation bias, right? I bought it, it went up, therefore I am smart.
Exactly. And they admitted they were showing off to everyone. They were that person at the party talking about their portfolio.
Yeah.
And today, they are negative.
Oof.
Not just zero gains, negative $200. All the progress of the last year just poof, wiped out in 4 days.
That is the classic retail trap. You ride the alligator up, but you take the window down.
And it's not just the money, it's the humiliation. You mentioned there was another user who would brag to their kids.
Yeah. Can you imagine that dinner table conversation? Hey, kids, remember how I said we were going to Disney? Well,
oh, no.
Someone in the comments actually quoted Proverbs at them. Pride goeth before the fall.
Ouch. That is just kicking a man when he's down.
But it highlights the psychology here, right? When you make money, you attribute it to your own intelligence. When you lose it, it feels like a personal failure. And right now, the specific things that retail investors love are failing the hardest.
Let's get into the why then, because usually when tech takes a hit, it's just a sector rotation. But the sources this week are pointing to something deeper, a fundamental reassessment of the biggest narrative of the last 2 years, artificial intelligence.
This is the elephant in the room. For 2 years, the strategy was so simple. AI is the future. Buy anything with a microchip.
Right.
But this week, that narrative shifted. The market woke up and realized we have a CAPEX problem.
Okay, let's unpack CAPEX. It stands for capital expenditures.
Right. It's the money companies spend on physical assets, infrastructure, data centers, cooling systems, all those chips. Big tech is spending hundreds of billions on this stuff right now. I mean, the sheer scale of the spending is unprecedented.
And the assumption was that this spending would turn into massive profits, right? That we'd build the brains and the brains would make the money.
Eventually, but eventually it's taking too long. The market is finally asking, where is the ROI?
The return on investment.
Yeah, where is it? There's a fascinating comment from a user, Heavy Original 4644. They argued that AI isn't siphoning jobs in a way that generates profit yet. Instead, corporations are firing people just to cut costs so they can service the debt they took on to build the AI.
Wow. That's a dark distinction.
Mm-hmm.
So it's not an efficiency boom where AI does the work better. It's a balance sheet shuffle where we fire humans to pay for the NVIDIA chips.
Precisely. It makes the economy feel hollow. You aren't growing revenue. You're just cannibalizing your own workforce to pay for infrastructure that isn't really producing a killer app yet.
And speaking of killer apps, there's a lot of chatter about Anthropic, the company behind the Claude AI model. Why is a company that isn't even publicly traded causing so much fear in the stock market?
This is what some are calling the sauce massacre, software as a service.
Right.
For a decade, buying sauce stock Salesforce, Adobe, Snowflake was a free money glitch. But now users are realizing that if Claude or ChatGPT can code better than your entry-level developers or just replace your subscription service with an agent, your whole business model is toast.
One user, Heisky1, mentioned they're a bag holder in a bunch of software stocks because they feel Anthropic is eating their lunch.
It's the unknown factor. Investors hate uncertainty more than anything. If I don't know if your software company will even exist in 3 years, I'm not buying your stock at a 50 times multiple. I'm selling it.
And it's not just the small players. People are coming for Microsoft in these threads. One user complained about a glitch in Excel this week that just messed up their work systems. They said, "You're spending billions on AI, but I can't even use my spreadsheet."
That is the frustration of valuation versus product. But there's a deeper, maybe even scarier theory floating around about AI value. A user named Hume's Bread brought this up.
This was the private versus public theory.
Yes, what if the real value in AI never hits the public market? OpenAI is private, Anthropic is private, SpaceX is private.
So retail investors, people like you and me, we're left fighting over the scraps.
That's the fear. We're buying the legacy public companies that are about to be disrupted by the private giants. If the biggest growth engines in human history stay private, the stock market just becomes a place where you hold the bag for dying dinosaurs while the VCs eat all the steak.
That creates a kind of structural pessimism about the public markets that's really hard to shake. Okay, so we have the tech bubble deflating. That's bad enough. But then you layer on the political situation,
Which is volatile.
to say the least. And we need to be careful here. We are just reporting what the sources are saying. But the anxiety about the U.S. administration is, I mean, it's palpable in these threads.
It's unavoidable. The threads are thick with it, and it's not just standard partisan bickering. It's specific economic anxiety. You see a lot of fear about tariffs, trade wars, specifically with China, maybe Mexico.
But the thing that really rattled the cage this week was the data reliability issue.
The firing of the head of labor statistics.
Yes, that came up a lot.
In finance, data is oxygen. If you can't trust the unemployment numbers or the inflation numbers because the person in charge was let go for political reasons, you are flying blind.
Users are calling the data blurry.
And markets hate blurry. If you can't price risk because you don't believe the numbers, you just sell the asset. You go to cash.
There was also mention of something called Project Pedo 2025, which seems to be a disparaging nickname users have for a set of policies they're worried about. But beyond the nicknames, there's a very technical political factor here. Warsh.
Kevin Warsh. Yeah, the rumor mill is in overdrive that he might be the pick for the new Fed chair.
And why does that matter? Why is the internet freaking out about a potential Fed chair?
Because the user butt-stuffing Jiro N.
I can't believe we have to say that name in a serious financial analysis.
Classic Reddit. But they made a very astute point. Warsh is known as a hard money guy. He historically opposes flooding the market with steroids.
And steroids is just quantitative easing, printing money.
Exactly. For the last 15 years, the market has been addicted to easy money. It's operated on the assumption that if things get bad, the Fed will step in and print. That's the Fed put.
And if Warsh gets in?
The market thinks the era of the Fed put is over, that he might let the market crash to clear out the rot. And since the market tries to price things in 6 months in advance...
If they think the liquidity tap turns off in May, they sell today.
Exactly. And this leads us to the thing that really makes this drop feel so different, the correlation breakdown.
Right. Because typically, if tech drops, you have a playbook. You buy gold. You buy silver. You hide in the bunker.
And that is why this week was a total bloodbath. There was nowhere to hide. Did you see what happened to gold and silver?
Crashed. Down 20% right alongside tech. It defied all logic.
One user said it best. They said, the market turned gold into a meme stock.
That is such a wild image. Gold, the ancient store of value, trading like some volatile crypto coin. Why does that happen? Why does safety itself sell off?
It signals a liquidity crisis. This is really important to understand. When big funds get margin calls, when they borrowed money and the stocks they bought drop, they have to come up with cash immediately.
Right now.
So they don't sell what they want to sell, they sell what they can sell.
They sell the family jewels to pay the bookie.
That's it. They sell the gold, they sell the silver, they sell the Bitcoin. It's forced deleveraging. It's not a rotation, it's a liquidation. And that is why it feels different. When everything correlates to when everything turns red at the same time, it means there is a systemic thirst for cash.
That explains the panic. It
Yeah.
feels like the floor is just falling out from under you. But I want to shift gears a little to how people are actually coping with this. Because the psychology in these threads it's a mix of tragedy and really dark comedy.
It's a support group for lost savings, basically.
I laughed out loud at the user Bionickel. Someone posted, staring at your phone won't make stocks go up, just raises your cortisol. And Bionickel replies, what's the ticker for cortisol? I'm going to buy calls on it.
It's the only asset class making new highs this week. Long stress, short relaxation.
And then there's the user Vincif. This person is trying to distract themselves from the crash, so they decided to start using their mouse with their left hand.
To train the other side of their brain?
Yes. They said, I need a distraction, might as well become ambidextrous while I lose my life savings.
You know, from a behavioral finance perspective, that's actually brilliant.
Really?
Yeah. Anything to keep your finger off the sell button during a panic is a good strategy. If it takes learning to use a mouse left-handed to prevent you from selling at the absolute bottom, do it.
Speaking of the sell button, there is a war going on in the comments between the DCA and chill crowd and the panic sellers.
Oh yeah, the veterans are out in force. They're quoting Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. They are trying to remind everyone that if your time horizon is 20 years, this week is just a blip. It's a sale.
But the panic is real, and
Yeah.
it's manifesting in these really weird ways. The grammar police were out.
Oh, the loose versus lose debate.
Yes. Someone posted this heart-wrenching story about losing their gains, saying, everyone lose and gain at some point, and half the comments are just correcting the spelling of lose.
It's petty, but I think it shows how on edge everyone is. When you can't control the global economy or your own portfolio, you try to control a stranger's spelling on the internet. It's displaced aggression.
Control is the key word. And timing the market is the ultimate attempt at control. We saw two perfect examples of how much luck plays into this. The house buyer.
Heart of Toenail, another great name. They just sell 1,600 shares of VTI, the total market index, at $342 to close on a house.
And they sold just days before the crash.
Pure luck. But it's framed as genius. They look like a financial wizard, but they were just buying a house.
And then you get the flip side. The user who waited for the dip, sat on cash for months, finally bought in on Monday thinking, this is it, I'm so smart, and then it dipped even harder.
Caught a falling knife? That hurts more than anything, thinking you timed it right and then getting crushed anyway.
So with all this chaos, what are people actually doing? What's the strategy on the ground?
It is split right down the middle. You have the fire sale buyers.
Yeah.
They are looking at this carnage and seeing opportunity.
What are they buying?
They're mentioning tickers like SoFaFi, Hood, that's Robinhood, and even Reddit's own stock, RDDT, and ETH, Ethereum.
So they're going all in?
Not quite. The strategy seems to be nibbling, small dies, testing the waters, because nobody knows where the bottom is.
And then you have the doomers.
The American hegemony is over, crowd. There are genuine comments about buying ammo, water, and tinfoil.
One user jokes, I got a good deal on a propeller hat if you want one. But the sentiment is real. Some people think this isn't a dip. It's the end of the experiment.
And that brings us to the most critical warning in these threads: leverage. If there is one takeaway from it, it is this: do not use margin.
A user, Jess Skilling, which is an ominous username, considering Enron, it said, leverage amplifies both risk and return. Who'da thunk?
It's a hard lesson. In a bull run, leverage feels like free money. In a correction, it wipes you out completely. The market is punishing the momentum investors who chased hype without fundamentals. The only things holding up are the boring stocks.
Wasco.
Costco. Consumer staples, the stuff people need, not the stuff people hope will change the world.
One user actually noted that Costco was the only green stock in their entire portfolio.
That tells you everything you need to know. People might stop paying for a ChatGPT subscription, but they aren't going to stop buying bulk toilet paper and rotisserie chickens.
So let's zoom out. What does this all mean for us? For the listener driving to work or hitting the gym right now?
I think we have to accept that this is a vibe shift.
A vibe shift. That sounds almost spiritual.
It is psychological. For the last couple of years, we've had this up-only mentality. AI is going to save us, productivity will boom, stocks only go up. That era might be pausing.
It's a reality check.
It is. The combination of questioning the ROI on AI, the political unpredictability, and the breakdown of those safe havens like gold, it has rattled the cage. Trees don't grow to the sky.
Then the free gains era might be over.
It might be. You might actually have to pick good companies again, not just buy the index and go to sleep. We might be moving from a market of growth at any cost to show me the money.
Before we wrap up, there was one thought in the threads that I just can't get out of my head. It's a bit conspiracy theory-ish, but it's mathematically spooky.
The 18-year cycle.
Yes. A user mentioned Liberation Day as a past benchmark, but then they pointed out this timeline. Look at the dates. 1990, 2008, 2026.
Okay, let's break that down. 1990 to 2008 is 18 years. 2008 to 2026 is 18 years.
And 2008 was the great financial crisis. 1990 was a recession year, too. So are we staring at a cycle that is just mathematically due to break?
It's a provocative thought. Humans are pattern-seeking machines, right? We look for order in the chaos. Is it a fundamental economic cycle, or is it just our brains trying to make sense of the noise? I don't know. But when you see liquidity drying up and leverage unwinding and all this political instability, the pattern fits surprisingly well.
It's enough to make you want to switch to a flip phone and move to a cabin.
Or at least delete your brokerage app for the weekend.
Well, on that cheerful note, the advice from the experts on Reddit is pretty simple.
Yeah.
Go for a walk, touch grass, and maybe.
Don't check your portfolio until Monday.
Thanks for listening to The Deep Dive. We'll see you on the other side of the weekend.